Warren Buffett just did something that should make every investor pay attention. He's sitting on $344 billion in cash. That's not a typo. $344 billion. That's more cash than Apple, Microsoft, and Nvidia have combined. And those are the three biggest companies on Earth. When the Oracle of Omaha stops buying stocks and starts hoarding cash, you need to understand why. Here's what Buffett has been doing for the past 11 straight quarters. He sold over $4 billion in Apple shares. He dumped 41% of his Bank of America position. That was worth over $1 billion. He completely liquidated his stake in T-Mobile and cut his Charter Communications position in half. 11 quarters in a row of selling. The last time he was actually buying? Third quarter of 2022. This isn't normal behavior for Berkshire Hathaway. Their entire business model is about putting money to work in great companies. So what does Buffett see that the rest of Wall Street doesn't? Now, before you panic, you need to know something important. This isn't Buffett's first rodeo with massive cash positions. Back in 2007, he built up a huge cash pile right before the financial crisis hit. The market crashed 60%. And Buffett? He went shopping. He deployed all that cash into investments at bargain prices in 2009 and 2010. Then in late 2021, his cash reserves hit another record high. Right before the market topped and dropped 20% into the 2022 bear market. Again, he bought the dip. His timing looks almost supernatural. But here's what he'll tell you himself. He's not trying to time the market. He's made it clear over and over that he never makes investment decisions based on economic predictions. So if he's not market timing, what's really going on? According to analysts who track Berkshire closely, there are three main reasons for this strategy. Reason number one, Buffett can't find anything worth buying at today's prices. Look at his favorite valuation metric. It's called the Buffett indicator because he's talked about it so much over the years. This measures the total stock market value compared to the size of the entire U.S. economy. Right now, it's sitting at over 200%. That means the stock market is valued at more than double what the American economy actually produces. This is the highest level we've seen since 1947. When you're a value investor like Buffett, your whole strategy is about finding great companies at fair prices. When everything's expensive, you wait. Where's all this extreme valuation coming from? A lot of it comes down to artificial intelligence hype. Even Sam Altman, the CEO of OpenAI, has publicly called the current AI market a bubble. Think about that. The guy leading the AI revolution is saying we're in a bubble. This probably explains why Buffett took profits on Apple, one of his best performing investments ever. There's also another problem. Market concentration. The 10 largest companies in the S&P 500 now make up more than 30% of the entire index. When that much weight sits on that few shoulders, the whole structure becomes fragile. History shows us that when markets get this top-heavy, corrections tend to follow. But Buffett's second concern is even bigger than overvalued stocks. It's about U.S. government debt and what it means for your dollars. The numbers are absolutely staggering. America's national debt now exceeds the country's entire gross domestic product. We owe more than we make as a nation. And history gives us a pretty clear warning. When countries get into this level of debt, they usually have only one way out. They print more money to cover what they owe. That leads to severe inflation. So how is Buffett actually positioning himself for these risks? He's not just sitting in cash doing nothing. He's been selectively buying specific types of businesses that can weather economic storms. Recently, he added positions in companies like D.R. Horton, a home builder, Lamar Advertising, which owns billboards, and Newer, an industrial manufacturer. These companies share three critical characteristics. So what does this mean for your own investing? You don't need $300 billion to apply Buffett's thinking. Here's what you can do right now. First, check your own portfolio. Are you fully invested just because you feel like you should be? Or are you making choices based on actual value? Second, build your own cash reserve, even if it's small. When markets get volatile, having cash available gives you options. You can buy quality investments when they're on sale instead of being forced to sell at the wrong time. Third, focus on businesses with real assets and strong cash flow, just like Buffett is doing. These companies tend to hold up better during economic uncertainty. And finally, remember that patience is a strategy. Not every moment requires action. Sometimes the smartest move is simply waiting for better opportunities. Buffett has proven over and over that being ready matters more than being constantly active. The financial world is watching what Warren Buffett does next. His $344 billion cash position isn't a prediction. It's a statement. It says that sometimes the best investment is the one you don't make yet. Great opportunities are coming. They always do. The question is whether you'll be ready when they arrive. If you want to stay updated on what major investors like Buffett, Michael Burry, and Bill Ackman are doing with their money, hit that subscribe button. We break down their strategies so you can apply the lessons to your own portfolio. Thanks for watching. And remember, in investing, patience isn't just a virtue. It's a competitive advantage. Stay tuned.